Good day, and you are welcome to Business and Finance here on Echo Television International. I am Rachel Tansey. And in the just concluded 298 NPC meeting, we are seeing a lot of updates concerning the monetary policies of the country, what the committee have decided, the base point increase on the MPR, and then what it means concerning inflation, the future of our currency value, and also the monetary policy in general and what it's going to mean. Now, at the last MPC meeting of September, the committee raised the monetary policy by 50 base points. Now, we're looking at it at 27.25%. Now, they're stating concerns on inflation and then money supply growth, fiscal deficit, and food price pressure. Now we'll look at our physical deposit ahead, but then for now, these were the major concerns in the previous MPC meeting. We're looking at the 297. Now, the MPC applauded the ongoing effort of the federal government to breach the food supply deficit through the duty-free import window for food commodities. However, we have seen that certain commodities are yet to come, despite saying that, the government is trying to do something about it, yet certain things are yet to kick off. Now, the committee also expressed optimism that lifting refined petroleum products from Dangote refinery will moderate transportation costs and significantly support the easing of food price pressure in short of medium term. Now, concerning lifting petroleum from the Dangote refinery, we are still seeing a few hitches left, right, center. We have some marketers, petroleum marketers, excited about it, and a little discrepancies left, right, center concerning the prices, what is being gotten from NNPCL and what we are getting, the prices they are able to get directly from Dangote refinery. And we have more oil marketers joining in the race from lifting directly from Dangote refinery. However, when it comes to the price of petrol at the pump price, it's still where it is. We're yet to see a decline or decrease. And for food inflation is another story on its own. Now, in the latest PMI data released by the Central Bank of Nigeria for October, the composite PMI weakened to 49.6 points from 50.5 points in September, halting 2 consecutive months of broad-based expansion in the business environment. And these are happenings after the MPC meeting for September. These are updates from October. Now, we're looking at from the where we are now currently at the just concluded MPC meeting. Now, their aim is to raise the MPR by 25 basis points. Now, the last MPC meeting was 50. Now we are seeing just 25 basis points that we are now seeing the MPR at 27.5% from 27.25%. Now they're also retaining the asymmetric corridor around the MPR at plus 500/-100 basis points. Also retain the cash reserve ratio of deposit money banks to 50% and merchant banks at 16%. So the cash reserve ratios for our deposit money banks is at 50%, and then when it comes to merchant bank, we are looking at it at 16%. Also to retain the liquidity ratio at 30%. These other outcomes are the just concluded NPC 298 meeting. Now, the meeting was held against renewed inflationary pressures as the headline food and core measure rose year on year in October 2024. The committee was particularly concerned that all 3 measures also inched up on a month-on-month basis, suggesting the persistence of price pressure with attendant adverse impacts on citizens' income and welfare. So it means that regardless of where marketers are picking petroleum from directly from the NNPCL or Dangote refinery, we are seeing that this move have not reduce the cost of food in the market or transportation whatsoever. It is still high. Therefore, the headline inflation, food inflation, nothing whatsoever around these policies, be it the monetary policies or activities, economic activities within the country, have been able to put this inflation at a rate where perhaps the Central Bank of Nigeria will be happy of the results. Now, we have to wait and see what the next MPR meeting will mean. How many basis points are we going to see an increase in the MPR? And if there will be any significant result in curbing inflation in the country. Now, debt service up by 91.5%. So we can say kudos to the Debt Management Office for being able to reach 91.5% in debt service, meaning we are seeing about $2.24 billion committed to debt servicing. Now, Nigeria has spent a total of $2.24 billion on external debt servicing in the first 6 months of the year. So this is the first and second quarter report of the year. We're yet to get that for the third, and of course the fourth quarter in which we're in. The amount of $1.07 billion, or 91.55% higher than the $1.17 billion that the country spent on servicing its external debt in the corresponding period of last year. So we're looking at a year-on-year report here. According to the actual external debt service payments data for April to June 2024, we're looking at now the second quarter of the year. Out of the sum of $1.12 billion that Nigerians spent on servicing external debt in the second quarter of this year, $672.01 million went into servicing debt owed multilateral financial institutions, MFI. Of course, we are looking at the World Bank and any other bank that have borrowed to us internationally, such as the International Development Association. So we're looking at the World Bank, the International Development Association, and the International Bank of Reconstruction and Development. We're also looking at the African Development Bank, where we have seen a lot of loans coming from the African Development Bank. We're also seeing the International Fund for Agriculture Development, the African Development Fund, the Africa Growing Together Fund, the European Development Fund, and the Islamic Development Bank. So these are all the banks, international financial institutes that our debt servicing have been going towards. Now, analysis of the Debt Management Office actual internal debt service payment data for January to March, and the first quarter, we've seen that of the second quarter and that of the first quarter for the year 2024, also indicates that the total sum of $1.12 billion spent on servicing external debt in the first quarter of the year was made up of $634.40 million for multilateral debt. We're looking at $197.43 million for bilateral debt and $288.18 million for commercial debt. Now, further analysis of the Debt Management Office data shows that while there was a significant increase in the total amount that the country spent on servicing external debt in the first half of the year, compared with the corresponding period of 2023, the amount of actual external debt service payment in the first quarter of 2024 was virtually unchanged from the previous quarter, that is the previous quarter of the year 2023. The last quarter of the year 2023 was not any different from what was being paid for the first quarter of this year 2024. Let's not forget, this is a year-on-year data. According to the Debt Management Office, the country's total external debt was relatively flat at $42.90 billion at the end of June 30th. That is the end of the second quarter of the year. We're looking at a half-year report here, compared with $42.12 billion at the end of the first quarter. So yes, we can see a significant difference between these figures. Now, internal debt hits a new high. So while the country is doing well in servicing our debt, let's not forget these are the interests that have accumulated on the actual debt. So that is what our debt servicing is doing. We're not paying the actual debt. Now, we're seeing that internal debt is still being incurred in the country. So we would have to do more concerning paying debt and also more when it comes to servicing the debt. Now, this is basically state-owned debt. And now we can see that, well, let's look at some number. Foreign debt hits 4.89 billion naira as states owe to 4.27 trillion naira local debt. We are seeing states like Lagos, Rivers, Kaduna, Delta, Odo topping the chart. The total debt of Nigerian states has risen to 11.47 trillion naira as of June. That is the second quarter of the year, despite higher allocations from the Federation Account Allocation Committee. Yes, we have been seeing states receiving higher. We are seeing trillions of naira being shared between the federal government, the state government, and local government, and the states getting the chunk. We're seeing states receiving billions of naira as monthly allocations, as we keep seeing these reports from the FAEC. And despite this increase in monthly allocation, we are seeing that, well, the debts are still piling for states. We've seen that the figure of the second quarter of 2024 represents a 14.57% increase from the 10.01 trillion naira recorded in December. That is the last quarter of the year 2023. It was at 10.01 trillion naira. Now we are here. The report for the second quarter of the year is at 11.47 trillion naira. External debt for the states and the federal capital territory climbed from $4.61 billion to $4.89 billion, reflecting a 6.14% increase. However, in naira terms, this figure surged by a staggering 73.46% from 4.15 trillion naira to 7.2 trillion naira following the devaluation of the naira from 899 dollar in December. That is the last quarter of the year 2023, and this is for the figure 1,470. However, the current exchange rate we are looking at, well, from in the parallel market, the unofficial market, or the black market as we know it, we're looking at our exchange rate currently at 1,670 naira, or 640 thereabout, and then at the official market is at around 1,500, almost reaching about 600. So as compared to what we had at the third quarter of our currency reaching 100 and 1,700, we're seeing a decrease is significant a little bit. However, this is a second quarter report. This was when we had our currency devaluing to 1,470 naira to a dollar. And fiscal deficit has reached 7.6% of our GDP. And we know where our GDP stands, but we're seeing our fiscal deficit at 7.6%. Well, it means that we can raise our eyebrows and say this doesn't look nice. Nigeria's fiscal deficit has surged to 7.6% of GDP as of August 2024, far exceeding the government's approved 3.8 target for the year. This troubling development was discussed in a statement from the Central Bank of Nigeria, and this is from the Monetary Policy Committee members, who highlighted the widening chasm between revenue collection and expenditure. And this is a clear proof. Our GDP growth rate is just around 3.6 thereabout, and we are having our fiscal deficit as against the GDP at 7.6%. The federal government was hoping it stays at 3.8%, but we are seeing a double figure here as compared to what the federal government was expecting it to be. At the onset of 2024, the National Assembly sanctioned a 28.7 trillion naira budget balanced against the projected revenue of 19.5 trillion naira, forecasting a budget shortfall of 9.1 trillion. We're looking at 3.8% of GDP. However, fiscal pressures intensified as a supplementary budget of 6.2 trillion naira was later proposed, aggravating the financial strain. Yes, we can remember the supplementary budget from President Bola Ahmed Tinubu, the proposed budget of 28.7 trillion, which ended up way higher than this, and also the estimated revenue. Now, the APC member noted a significant revenue underperformance, with only 37.9% of the year's target achieved by mid-year. These underachievements stemmed from shortfalls in Federation Account Allocation Committee receipts, impeding the federal government's fiscal capabilities, despite a 3.31% increase in retained revenue between January and June. Compared to 2023, the revenue deficit still stood at stark 62.1%. Now, this statement is from Lamido Yuguda, another MPC member, linked the fiscal deficit to Nigeria's persistently low revenue base, which constrained financial performance in the first half of the year. By June, provisional data revealed that the deficit has reached 91.94% of the full-year target, raising red flags over how remaining expenditures will be financed without further exacerbating the shortfall. So we can see that so much is happening, and we have a government, doing budgets on estimations of revenue, and this is what it means, that eventually our fiscal deficit will always be way higher than our GDP growth and our rate. And we're also looking at the same thing coming forward to the 2025 budget proposal. The government is still estimating a revenue generation that we are yet to reach that level. And so it means that if we are at a GDP growth rate of 3.2% or thereabout, or 3.4 in the latest data, and then we are having our fiscal deficit at 7.8, we might see higher figure for fiscal deficit and even a decline in our GDP growth rate. Advanced talks on pipeline projects have been ongoing. Now, Nigeria, Morocco, ECOWAS have advanced. This discussion started a long time ago, but it's about time the financing began. We're looking at $26 billion to be pushed in or funded for this pipeline project. Now, the NMGP project is an initiative of the federal government and the Kingdom of Morocco, and was conceived during the visit of King Mohammed VI of Morocco to Nigeria in December 2026. So we can say that this is dating back. We're looking at 8 years ago, and it's yet to begin. However, we're seeing an extensive talk, and this will assist in supplying gas to Morocco and 13 other ECOWAS countries and Europe, as well as an integration of economies in the sub region. So yes, we have to keep our eyes open, keep tabs on this, because anything that has to do with trading, this means more trading opportunities for us as a country to be able to supply gas not only to Morocco, but we're looking at 13 other African countries. This might eventually mean a boost in our currency, of course, the value of our currency, apart from the balance of trade and many, many other ties that this will bring, or security for the country when it comes to trade and even growth as a country entirely. Now, thank you for keeping the day with me on Business and Finance today. Till I come your way another time, goodbye.